Hello, everyone. This is CM, chat moderator Randy Opper, and we're going to begin today. This is the start of the price action education course. Uh, we're going to begin with that this presentation was built, and although I will often refer to it as my method, it was learned on the basis of being mentored from Dan Zanger. So I learned how to trade as a factor of listening to Dan, but also watching Dan's behavior and several other traders, but mostly Dan and how he behaved. So although Dan may not voice the same discussion over some of these key training points in this video, it's things that he does see in the market um, nearly automatically because of his number of years of looking at the market. So we're going to start out here today. I hope everybody's ready. Get out your Red Bull and get ready to focus. So we're going to start with housekeeping. This is required to teach you the method and give you some key information about the process of learning what I do. But understand that these factors may even be more important than method. And we're going to go over those right now. But don't ignore the fact of the busy work that's involved in this process. So we'll begin with method information. Everything we talk about today is impossible to absorb in a single day, week, or month. But in time, it will become more apparent. There are people in this webinar that have been trading for 40 years. And there are also traders that have joined this webinar that are 1 year in the market. Because of this variance, you would think the person 40 years would know everything that's necessary. And the answer is they probably do. But it's often forgotten that the simplicity of the simple items in the market get forgotten in the noise of all of the factors that are involved in this process. And so I just want to remind the people that have done this a long time, while you may instantly see something that you already know, it's the application of that that makes the difference of whether it's powerful or not. The application of simple principles can be the difference of making trading more easy to deal with or more difficult to deal with. So just understand that it's not a one-day thing here for anyone. It takes a long time to absorb and use it all and see that light bulb go off in your head when you realize you can read this. You can read price. Now, getting started, there are items here that are more to do with your success than my method. And I hate to disappoint everybody. I know this is the part I'm not as passionate about. When we get to the charts, you'll hear me change my voice because I get really passionate about those things. But these items have more to do with success than even reading the market properly. And that is, number one, discipline and patience. Discipline and patience are the largest driver of returns. If you don't have discipline and self-control, you need to work on it. If you're not willing to work on it, you will be your worst enemy and you will lose money even with skill. Skill gets destroyed without discipline. Our heads, our negativity in our heads can blow perfectly good trades. And we can be self-sabotaging ourselves when it comes to trading. So it's very important that we have our heads straight. Number two, stop searching for the holy grail. No risk, you're not going to lose method. Does not exist. I believe the holy grail is math, the formula of small risk for bigger reward. That's what I learned from watching Dan. It was very apparent to me. But I will say that people will jump from method to method to method every time they have 3 or 4 losers in a row, and they will never find the path to success. They will claim that the market is impossible. They will quit. They will be run out of the business because they just couldn't sit still, stay one place, and make small tweaks to improve rather than wholesale changes. Number three, follow the process, not your account balance. If you're looking at your account balance after every trade, well, of course, at least for me, 30% of the time, my account balance drops after the last trade because I'm not right all the time. But I need to follow the process because if I don't take the next trade after two losses, that's probably the big winner. It This is a business where you're going to have mental capital that is damaged. Forget the financial capital. Emotional capital is very difficult to manage. You can't play with your emotions like that. We need to follow a process and let the money follow from behaving correctly. Number four, stop asking the market for favors. If the stock has gone down for 3 years straight, do we really think we're good enough to pick the one low that's going to turn price and going to lift it up? I don't think I'm that good. I don't try to ask for favors like that. I don't try to ask for a favor when a stock is acting poorly that I'm going to pick the exact low as easily. I need a lot of proof in that case. So, when we get long a stock and we ride into an area which is really difficult to surmount, we don't maybe want to ask for favors there. Maybe we want to take a partial exit and move our stop up because we know the only way we're getting that favor is if the market provides us that favor. We can't produce it. Number five, expect the losing trade. Take a small loss. I hear this 4 times a month where I get an email from a person who was getting chopped up a little bit, didn't understand Dan's method because they were misusing it. And then they proceed to stop taking small losses and proceed to hold something because they think that they're tired of the small losses. In which case, they're now down 50 or 70% in their account because they didn't take the small loss. They now have a big loss, and they want me to tell them what to do. And at that point, I have to provide them the bad news, which is now, of course, I have to tell you to kill that position, in which case it could then reverse 2 days later and you are totally wrong and your mind will be even more messed up. But the answer to this problem is take the loss while it's small. When you're clear-headed and out of the position, you can think and justify a new trade as it develops. You can't hold on to a loser because you will go through mental anguish, and this will destroy an account. Number 6, no bias. I am saying this because I see this day in and day out. You get people fixated on a direction and how good a stock is behaving, and they ignore every warning sign that is blaring in their face. You can't do that. You must read price, see both sides, read it for what it is so that you don't get the 2x4. I mentioned that 2x4, that wood 2x4 getting smacked on the back of my head. Every time I smile, really smile in the market, I'm looking for that 2x4 because that's when they come for me. And every time I'm really afraid about a position, I also check myself because I know that's probably a reversal coming. That doesn't mean I hold it if it broke my rules. It just means I'm aware that my emotions and bias affect where I'm at on the playing board and where I'm at in the market. So, number 7, always give credit to the current trend and limit trading against it. This is a big issue for many traders, and this is a psychological issue for most that start out trading, which is you want to buy the stock that's really low in the chart. It's moved from the top left to the bottom right. The stock is falling down the whole time, and you want to pick the spot where it's going to be the bottom at $6 because it's cheap and ride it up to 100. And while the theory is great, and while 1 in 1,000 work that way, you're better off asking to get onto an existing trend, to step on a moving bus in one direction, than trying to ask for it to turn and reverse and change trend. And you're better off not shorting strong trends or buying weak trends that are downtrends. You're better off trying to find and ask for zero favors and do what price has already been doing, just simply ask to step on it. So we want to give credit to what is already happening. And we want to step onto that trend and enter in with it, not against it. Now, some of you will build skill from this course to do some counter trend trading, but I still say limit doing it because the market does not reward us as well for fighting what is already the trend. Number 8, develop a plan that works for you and stick to it. And this is very important. You'll notice my plan has a small set of adjustments to what Dan does. And in some areas, it has a large adjustment to what Dan does. That's because I had to develop it for me. And I have to use it. I can't be exactly Dan. See, Dan's method is the most powerful method I have ever seen when the market is right. The few times a year where the market is truly set up for big moves, there is no faster gains that I have ever made in the market than when Dan is in one of his markets. I can't make the kind of money that I made on Acacia or ACIA from 32 to 120s in any other market than when Dan is in one of those really good spots. So my accounts climb and step up, and then all of a sudden the Dan market occurs, and then my accounts go up massively. Like I have months where I've done 40, 100% in a single month when Dan's market exists, that momentum strong market. So I never skip being aware that my plan is to follow what I do while waiting, because I didn't have the discipline personally to sit and wait for the 2 times per year. I would be dabbling in the middle and getting myself in trouble trying to buy strength. I'm going to show you what I found to do while I'm waiting for that big market to step up. And when Dan's market steps up to the plate, like in baseball, when they step up and you've got a really good pitch coming, I stop everything and I start being Dan Zanger's method. But as you'll learn, you have to adjust to what your personality is like. And then you have to stick with it. Now, number 9, you can track that trading and make minor adjustments. You make one adjustment at a time. You don't change 3 things where you can't figure out what you messed up. But you make minor adjustments and you deploy your strategy based on the current market conditions. For instance, I'm a pullback buyer very often. But when I'm in a really strong market like Dan is, I'll buy strength. But when Dan isn't busy buying strength in a really strong market, I roll back to pullbacks. So I'm aware of my process. I'm aware that I have a few different kinds of trades that can be deployed in different circumstances. And I will weekly review or look back at what my trades have looked like and make minor tweaks. Again, if you change 4 things, how do you figure out what worked and what didn't? You confuse yourself. So we need to, stay on track with our plan. Now, removing money from your thought process is one of the reasons I see a number of traders every single day failing. And most people fail at this, let's be completely honest. Most people, even if I hand them the holy grail set of tools and information, will still fail. And that is because of emotions and because this is a psychological game. Emotions will cloud your judgment and hurt you in this process. And so if you cut your size on your trading until a point where each loss never phases you, you're totally unfazed by any loss, your trading will improve because you'll be able to read the market clearly. You'll be able to see all sides. Now, for anybody in this webinar or this class who is consistently profitable for months on end and years, meaning you generally are green most months of the year and most years, then I say ignore what I'm saying here because your emotions are not ruining this process for you. You have it in control. For those of you who find yourself constantly struggling, until you cut the size and get the money out of the process, you will never see clearly what the market provides. I suggest no more than 1% risk of your account balance per trade that you adjust each week. So if you have a $100,000 account, the maximum you can lose on this trade, this next trade, would be $1,000. Now, depending on the stop size, you may own 500 shares in one case because you need a $2 stop. And the next trade, you may only need a $1 stop, and so you can own 1,000 shares. But the key is that it is a defined fixed amount of risk. For many of you, 1% will be too much for your emotions still. You'll have a $100,000 account, you'll lose 3 trades in a row, you're down $3,000, and it'll mentally affect you and you can't see clearly. Cut the risk down until you first get your read on the market correct. Then you can worry about working on your psyche to get the size up. If you follow the process, the money will follow. If you follow your balance or you follow your fear will mislead you. Your fear is reversed. It's reversed in the market. When the chat room is all excited, I'm looking around for what the problem is. When the chat room is fearful and calling for the end of the market in an uptrend, I'm looking for a long. So you have a great edge in the chart pattern chat room, which is you use the crowd to understand what's going on. Fear for them is potentially a buy, and excitement for them is potentially a sell. Now, I don't sell or buy just based on that. I use a process, but it's one of the things that's in my head when I see the behavior of other humans. Now, the next one is an opinion of mine. Some of you will not agree, but I believe that nobody should paper trade or sim trade in the market. And the reason for this is very simple. We are not deploying or using our emotions when we're using paper trading or sim trading. Most people are geniuses when they do sim trading, and then they go to cash to actually trade their money, and they fall apart miserably. So why do we want to duplicate something that is unrealistic? I don't care if you use $10 risk per trade, or you say, I don't care if I lose 100 trades in a row, I can afford this. The fact is, I need you to have your emotions involved in the process, and you need to be controlling them, because your emotions and your ego is the hardest aspect of trading. Again, all the skill in the world can be overcome by fear of loss and excitement over gains in the market. It can all be destroyed in an instant. The moment your emotions are out of control, I can tell you I lose because of my emotions. My largest size trades are usually losers. My smaller size trade where I just say, oh, the rules say I got to go long, that of course becomes my biggest winner. And traders have complained for years and years and years since trading started that, oh, you never have enough of your big winners and you always have too much of the losers. That's partially psychology, and it affects all of us. Expect and accept small losses. Again, I just want to repeat, you have to accept when you're wrong. The market is giving us information. It's telling a story. When you're told that you're wrong in your theory, you get out. You don't defend a name. These are not stocks we defend symbols for. When I'm trading Apple, it's not about Apple. It's not about my great iPhone. It's not about my great iPad that I love. It's a symbol, and I don't care whether it's the S&P futures or whether the stock is Goldman Sachs or Yelp. Whatever the stock is, we have to read it clearly for what it is. We cannot be involved in the psychology of what product they make or what service they provide, because we may not read something clearly. People look at the futures as there's some kind of mystique that they don't understand. The futures are a 24-hour vehicle of the SPY in the case of the S&P. The NASDAQ is the NQ futures are nothing more than the QQQ traded 24 hours. There is no mystique. It's a symbol, and we use that information to find trades. So don't fall into the trap. Next one, stops. This one I've learned from 2 flash crashes. And I say set emergency stops in case of a black swan visit. So the power of this lesson was confirmed in 2 flash crashes I have experienced. This means you may be stopped out in your mind. You plan to be stopped out in $1. But you may want to lay your stop 3 points below and just hide it down there just for emergency. So if you go out for the day and you forget the position, or you step downstairs to go get a sandwich and there's a flash crash or a market break or some piece of news in that sector, you're out. Now, one of you is going to come to me and say, I did that and it stopped me out to the tick and then it ran up. I'm sorry. Yes, you can have somebody take you out of a position. But more importantly is we're going to preserve our capital so we stay in the game. We don't need a game-ending experience where we get knocked out forever. So we need to defend ourselves. This is a very important tool. And while you don't have to put it close where you would normally sell based on what you're looking for, you just need to put in that E-stop, that emergency position protection. Attempt to always place your stops, the stops you're going to use, not the emergency stop, but always attempt to place it where your trade is no longer valid. Now, this is not about your personal choice. This is not about you wanting your small stop because you don't want to risk and you want 1,000 shares and you're not willing to use 500 shares because you need, $2 room. This is about accepting what the chart says that would invalidate your trade. If you have a major support level that you're, let's say, buying off of, or a major pattern that you're buying off of, and the pattern fails, that's a good reason that your trade is no longer valid. If you set stops based on what you like rather than what price says, you will lose and your stops will be hit more. So when you evaluate a trade, you must look to see what would invalidate the pattern or the information that would make your trade no longer valid. If you place your stops in those locations, this will be a good reason to get out. If you place them 30 cents away just because you want to scalp and try to get in, and it means nothing to the market, you're going to get run over. So respect what price is telling you. And most importantly on this sheet, when it comes to placing those stops, never enter a trade without defining that location where the trade idea will end, where the idea is no longer valid. So it's very important that you understand when you enter a trade, you know where that spot is that would say, I'm wrong. You can't figure out risk reward. You can't figure out the formula of the trade's validity without knowing where it's invalid. Next one. No free lunch. And I know some of you are not excited about all these rules and conditions and want me to get to the charts. But these conditions and issues are as much, if not more important, always than charts. We need to have our heads straight and our rules straight to manage what we're going to do next, which is read the market. If you're looking for easy money, this is not the right business. I'm telling you now, this is a business where you struggle a large part of the time in figuring out what is right or what's wrong or reading the market. It's not a 1, 2, 3 collect. It's a plotting process, a daily grind to find that great trade. And yes, it is exciting and there's elation when you hit it, but the fact is you only get out what you put in. Dan Zanger sat me down and I had all these illusions of all the stuff I was going to buy and how he had made so many millions. And he set me straight and said, When I made all that money, I didn't buy anything. I didn't get excited and buy toys because if I thought that way, I could lose that money. You need to go into this as being you're going to put in the effort and the money will follow automatically. You're going to do the right things in the market and the money will be provided. If you don't do the homework, you're going to lose and expect it. If you don't put in the effort to control your emotions, you're going to lose. You're going to need to expect that. If you're a negative person and you come into the market that you're going to lose, your own brain is going to cause you to lose. Your own emotions, your own self-defeating behavior is going to take you out of the game. You can't do these things. There is no free lunch. This is not easy money. This is the most phenomenal game on the planet Earth and the greatest way, in my opinion, to make money in the world. But the money comes as an afterthought from good behavior in the market. Now, this one is incredibly important to you. If you've been in the chat room for a period of time, then you have seen this happen 1,000 times. Everything works sometimes. Dan will walk in and say, this stock is not good. It'll look like it won't go any higher. And there'll invariably be one person an hour later that will say, look, it's up $2 from where Dad said that it didn't look good. It didn't mean that was probable. It just means that in the market, anything can happen. Don't fall into the random rewards trap. Don't do what the market, don't focus on what the market does that's not probable that you can't duplicate. If you take 10 scenarios of the same situation and 90% of the time that's not going to work, the one time it does, there's no excitement. You just know that's how the market works. Rookies constantly justify a bad trade by saying it worked. Doesn't matter that it worked. If you continue on your path, that one win will be blown away by the 10 losses that are coming. We do what is probable, what works most of the time, not what worked the one time that a news story came out that they invented, a new kind of product that jumped the stock at that moment. We're not in the game to pray that some news story is going to happen again. We're in the game to do what is probable, and we will be paid by doing that more than not. If you win from a bad trade, note that you're lucky. You have to know when you're lucky. Don't let it happen again. You see people who will justify saying, well, it's weakened to new highs and the volume isn't there, but I'll just take a shot. And it goes up $3 and they'll actually be jumping up and down in chat. And then an hour later, they'll be eating the position. Do what is the right thing with your behavior and stop getting lucky as part of the process to dig you out of the hole. Let the luck be handed to you when you behave properly in the market. Remember, a 5-year-old, a monkey, anybody can create a winning trade. All it takes is a dart. You could literally get a 5-year-old to point to the newspaper, and a 5-year-old can pick a stock that can move up for 3 years straight. That's random rewards. That's not the aspect we control. Homework. This one doesn't go over well with a lot of people. And in fact, most people that have kids like myself, when I first started, make all the excuses in the world. Well, who has time for homework? I'll just wait and figure it out during the next day. And this was horrible for my account. Almost all traders will be better off by planning than trading impulsively. So when you jump into the market the day of and the market is moving and people in chat or people around you or the market is flying, you're psychologically affected. You turn bullish or bearish based on the behavior. You're not unbiased and you're not reading the market. If you have your spots, your items, your support and resistance drawn out on your stocks and indexes before the start of the day, you can actually plan what you might do if they happen. You may say, I drew a trend line here. If price breaks out of this trend line and doesn't have the volume and doesn't follow through, I'm going to short or I'm going to sit on the sidelines. But if it breaks through on heavy volume here, It has some room to run up to here, so I'll get in if I see that. If you plan, then you can handle the market better. When I trade impulsively, when I jump, I will show you some live errors that I make. I make errors because I didn't plan and because my impulsiveness drew me into a situation with very few reasons for that trade. And few reasons means that I'm acting like a rookie. I need to have my reasons stacked up to step in the market. The market preys upon people who run up to the buffet table and will feed on every little uptick. We need to look at the buffet table and stop eating butter packets and wait for them to lay out the lobster on the table. Now, when you get to the table, there may not be any lobster there. They may be serving nothing but fillers. There may be nothing but garbage on the table. If you wait for your pitch, as we talk about it, Dan uses the word pitch or your fat pitch. If you wait at that buffet table and they finally bring in the steak and the seafood, you wait for that pitch, and that's where you end up starting to look for your trades. Some of your largest trades will be based on simple planning in the quiet calm of a closed market. Why is this? Well, our emotions are not pulled as much when the market is closed. There's nothing moving. So we're not missing. We have no fear of missing out at that moment because it's not running. Or we're not afraid of that it's going to take us out on our stop because there's nothing moving. We can think clearly. So if we plan and we review charts at night in the quiet calm, and we review Dan's newsletter in the quiet calm, we can evaluate where the market is and how it's behaving cleaner than we can when it's moving. This is the strength of homework. Also note, as Dan has reminded me for years when I've made mistakes, know that you do not have to make a trade every day or even every week. Look, if the market is a choppy mess, and I'm going to show you why chop occurs, but let's say price is stuck in an area, your trades aren't going to get very far in distance. You have to be on a really small time frame to get a trade with a small risk and a larger reward. Otherwise, you're asking for favors again. So if you note that, and you note that your last 5 trades in a row have been really difficult and aren't making any money, then you know there's a market change. You can change your behavior and do less. It's not you putting up the white flag and giving up. It's you stepping back to know your strengths and your weaknesses. Simple equals magic. I know everybody in this room wants to see me put up some magical line or tool that's going to change their lives. And I have a few things in here that are, to me, just exceptional. And I'm actually not wanting to share because they are, some strengths that I have over everybody else when I see people in a chat room, the way I call the tops and bottoms and things like that. But this isn't an intellectual endeavor. I see people who will defend based on intellect. They will say, oh, this stock has phenomenal growth numbers and figures and it should do really well, and the stock is dropping. All that matters is the stock is dropping. Dan taught me to read the fundamentals. If the fundamentals and the technicals agree, we have a trade. That's putting those pieces together. If the fundamentals are fantastic and the stock is dropping like a rock, something's wrong with the fundamentals. Maybe the next quarter they're going to bomb. Maybe the product has just been beat out by a better technology. We don't go by intellect as our way of beating the market because there's rooms full of PhDs that are sitting around using intellect as well to build computer programs to beat you. We in this class are learning how to be experts in reaction, reading reactions. Be prepared on this course to see much of what you already know. There is no magic that is needed to win. If you see simple things, you can win. And I want to mention something I want people to think about here. How many times have you struggled on a day and then that night or that afternoon you looked at your charts and you saw the most gorgeous buy or sell that happened 2 days ago? You look back and you see these gorgeous entries and exits that you totally missed. You were so enthralled with the hard right edge of your chart screen and trying to figure out why this big red bar was driving you crazy because you were losing, that you missed out on the most gorgeous, perfect breakout or the most gorgeous, perfect pullback that was so easy to see in hindsight. We cannot afford to miss simple. We can afford to miss complex, but the simple, easy spots in the market, we need to do our homework and we need to see those because those are the biggest winners. You see them 6 months later on the chart. They're as visible as day. I noticed that with learning from Dan Zanger. I noticed I looked back on certain newsletters and I would just say, what a simple pattern, just a little flag, but on a really strong stock. And Dan had this massive winner and I will have skipped it and didn't pay attention. And I look back and 6 months later, you can see it so easily in the chart. It's popping off the page, the easy trade. And I didn't take it. But I'm futzing with some hourly chart trying to get into some struggling, difficult trade. Why? I don't know why we do this. I don't know why my psychology made me want to be self-destructive and fight for something that wasn't worth it comparative to missing the layup, missing the easy situation. I can't tell you why, but I have done it 1,000 times, and it's the thing I try to avoid. I try not to ignore simplicity because while I'm trying to fight in the minutia of outsmarting the market, the really clear, easy trade is right in front of my face. Why traders fail. I see the truth is that 99% really fail at this. They may not say they're failures, but they're not making any money or they're losing money and they stick with it because they're addicted to the action or can't accept reality. But these are the things I see. Impulsive trading, we've talked about. No plan, meaning willing to do whatever they see in the day, reacting to that day's action and not accepting the fact of what the future of that behavior will present. So if you look at your trading and say, oh man, here's a trade, I got to do this one. You got to think to yourself in the past, I've been doing this for 3 months. None of it has worked. My account is lower. Maybe this isn't working. Maybe I need to do that weekly review and see what about myself I'm doing that is causing me to consistently lose. Your last 5 trades, 3 trades, 10 trades tell you a lot of information about what's working and what isn't. Make a few tweaks, small, one at a time, and adjust. But I tell people all the time, I see them trading what is hot. Oh, today this stock is in play. It's huge volume. Do you make money doing that? Or are you doing that because it's hot that day and you want to be active and involved in the big name? That's not what trading is about. I don't care if the stock goes up 83% in one day. I need to know myself enough to know that I make money when I do X, whatever that X is for you. I make money when I catch nice pullbacks waiting for a Dan market. When the Dan market hits, I make money buying strength with him. That's it. I know myself. When I go off the path, sure, I may even get fooled by random rewards. One of them will work. That's the worst thing that happened to me. That's walking into the casino and pulling the one-armed bandit and saying, oh, wow, I made $20,000 on the first pull. That's luck. The next 100 pulls could be absolutely losing that $20,000. So know yourself immediately. Trading your ego. I see this in chat. You'll see somebody defend a reason for a trade because they believe it. Oh, this stock can't go down. Absolutely. Amazon's not going anywhere. They're selling like hotcakes. They have their web services are the top of the industry. The stock is going down. I'm sorry, all of your reasons don't matter. Let's reprice. Let's accept what the pros are doing to the stock. Because guess what? We're not the ones that are causing it. There's professional money. If Fidelity wants out of Amazon, we're going to feel it. Next one, trying to stop the trend. See it time and time again. The strongest name in the market, everyone is trying to attack to call the top on it. And guess what? I did it too. I called the top on AZO, AutoZone, when the stock was at 250. I think it trades at 700 and something right now. We all want to be smart enough to call something that's incredible so we can say to everybody how smart we were. That's not how we make money. The truth is, we make money by doing what is easier, following what price is already doing. Next one, we talked about not honoring small stops. Over leverage, thinking that you're going to double and triple your size on this trade because you know it's going to work. Of course, your emotions then block you from seeing that the trade is working awful and it's about to absolutely collapse, and you miss that information to react because you're over leveraged. And because that big loss now, that huge loss, now you're down 15%, 20% in your account, which means you got to do double that to get back to break even. And that over leverage now emotionally affects you. So the next trades you start self-sabotaging, or you make a few trades up because you're trying to get your money back. These are all horrible. Over trading, pushing the button to fill the account thinking you're going to create a salary or an income. I have to tell you, 99.9% of the people I see that try to get a salary out of the market have less money in their account. You wait for the trade. It exists. It creates the income. The consistency comes by waiting for what you can understand and read. Revenge trading during a negative streak. I've done this 100 times. Had a bad streak, all of a sudden I'm losing some money. I say, okay, I'm going to start taking shots at things. Horrible. We have to wait for even better trades at that moment because our psyche is messed up. We're emotionally in a bad place. Next one, collecting small profits after commissions, slippage, and errors. You'll see somebody in the chat saying, wow, Dan, you missed this. It just went up 40 cents. And they won't even realize the stock needed $5 below it to see if it's true that would work. What's the point in collecting 30 cents in front of a $5 risk? Yeah, even if it works, that was a gamble that wasn't worth taking per se. So pennies in front of a steamroller is what I call it. We're not here to do that, and we're not here to be correct. We're just here for a salary or an income that comes from doing the right thing. And I use the wrong word salary because it's not as consistent as a salary. We create an income because price gives us that opportunity. We can't create the conditions. The conditions are created by the market, and we enter with those conditions. Trading on opinion and ignoring technicals. We've discussed this before. Your opinion on a stock, your idea about a stock. Just so you know, on GoPro, I said the entire time this stock was moving up, how many action sports stars are there on the planet to buy this product? I also said, can't anybody create a polycarbonate shell to put on top of a Nikon or another branded camera and call it a GoPro? Why does GoPro exist? Well, guess what? Yeah, now I'm right. But if I had taken those shorts against that, the stock went up from months just straight up. I would have been crushed and destroyed trading my opinion. It's great to have an opinion, as long as you're not trading it. We need to trade what price says, what pros are doing with the stock, and pros control the chessboard. And the last one on this sheet is misidentification of luck versus skill. You need to know when you're lucky, when you got away with murder, because skill is usually a lot less part of the formula than luck. We just recently came off an incredibly strong market where we had rookies on the site that had traded using the method for 4 to 6 months, and they were up 100%, 50%, 70%, 100%. And they're writing letters saying how wonderful it works. And those same rookies don't realize that was because the market was easy. It was handing out favors. We want to be in a proper trade, and the market provides the favor, not asking for the favor, because when we ask, we eat trades. And so we want to be careful. We don't want to be losing because we asked for a favor and the market did what it was supposed to do. We simply want to be provided that favor when we enter properly and the trend or the conditions pay us. Expectancy. This is the formula everyone has asked me about in chat for years. You can search on Google what expectancy is, but I'm going to explain my use of the formula. I use 5-to-1 risk versus reward as my first target. This is simple math, and it allows me to be wrong and still come out with a positive account balance. And the reason this works is very simple. My first target distance, when I look at the chart of what's in the way, the hurdles that are in the way, the distance must be 5 times the distance of the stop that I'm seeing. So if I see that this pattern is completely destroyed with a $1 stop, I need to look 5 times that, up $5 above, to see what's in the way. If there's nothing in the way, I've got a risk of $1 for a target of 5 as my minimum. I can take that risk. Now, the reason for this is simple. Sure, some of the time I'm right 70% of the time, and 7 out of 10 trades will work. And then I'll have a bad streak, and 6 out of 10 will fail. I will be wrong. I'll be 40% accurate. And it'll be hurting. I'll mentally be feeling the losses. But the losses will be $1, $2, $1. And then the one win will be $10, $15, $6, $7. It'll be multiples of the loss. The small losses, even a group of them, will add up to less usually than the one nice winner. And so big winners, small losers. This I learned from watching Dan. I didn't see him say the 5-to-1 risk reward. I didn't have him explain it that way. I didn't see him explain it that way. But I saw him looking for spots with low risk and a much bigger reward. And the math for that was simple. He didn't expect to be always correct. He knew he was going to be wrong. In the wrong market, he expected to be wrong. But it's those small paper cuts he could accept because the one nice winner, an Acacia, an ACIA, eats 50 losers in one shot. It blows away all of the mistakes in one shot. A Twillo or a Ren, they just eat up small losers. And so we need to put ourselves in a position where we can win even when we have problems with our trading process, when we have small losses and it's not working well. Now, this does not mean I'm looking to only make 5 times the risk that I have. If I have a $1 stop, sure, I'm looking for hurdles to see if it has clear room for $5 in target from that spot. But then I'm selling some, and I'm letting runners go further than that. And especially if I'm with the trend, those runners could last for months or years. That's possible to keep running for potentially years. We don't know. We're going to have to look at that on a technical basis. So I scale out based on this formula. Now, once I reach that first target, or once you reach your first target, your task is to allow winners to run and scale strictly by using price action. Now, let me contradict this for a second and explain. You're going to learn to read price, and you're going to know how to use this better as you understand the method. If you're in a trading range like at the time of this recording where price is stuck falling back and forth, you're going to get to your 5-to-1 risk reward, and you're going to sell a portion of that position, and the rest of it's going to come back to your cost. And it's going to happen on 10 trades. You're going to be saying to yourself, nothing's working any further than the first spot. I'm not going anywhere. I barely get my first target, and then it's back to my cost. And the answer to that is simple. That tells you what's going on with the current trend. If the current trend is strong and you're in an uptrend, let's say, and you hit that first target, your idea is to take out a small portion, maybe 20% as I'm showing here with the current trend, and then leave 80% to let the market reward you. The gift of the trend just keeps going. And this way you've taken something out, your mental capital is preserved, you're positive about the trade, you move your stop up to break even, you say, let it keep running. And you'll read price and determine based on the behavior whether you want to start reducing more, whether you want to start scaling out partial pieces of the position until it's all gone. If it's a counter trend trade, if you're asking for something to change what it is already doing, if you're at the top of the market, you're within 1% of the top of the market and you're looking for shorts, well, when you hit that first target area, that first hurdle, you better be covering most of that position, because the odds are it's going to bounce against you, feverishly flying back at you, and you're going to freak out as it's coming at you like a rocket, and then sell the position and have lost potentially much more of the gains than having proper scaled out at a proper level. So the point is, when you see a trade that's counter trend trading, you have to be thinking to yourself, I'm asking for a favor if it needs to bust this area. So I'm going to sell 80% here, or I'm going to sell 75% here, and I'm going to only leave 20 or 25%. And if I get lucky and everything breaks down, I have this beautiful runner that keeps paying me, and I can scale out more as it keeps falling, and it hits new hurdles. But if I hold 80% of that position and only take 20, when it comes flying back at me, I'm going to freak out and say to myself, well, great, now I lost all my gains. Or wait a second, I'm going to see what happens here. And then it's going to fly above what you paid for it or where you shorted it, and you're going to lose on that trade. And the mental pain is going to be just horrible. And the market told you you were asking for a favor. You just didn't accept it. So we need to accept what the market says to us. Member cycle. Now I'm going to discuss something here that is an unfortunate aspect that I've watched for nearly the last 10 years of watching the market. And that process is how the cycle of a member occurs for most people who follow Dan even. And that is, they will come onto the site when they learn about Dan. They will usually learn about Dan because of some recent successful trades, like an Acacia. People will find out that Dan nailed the stock. It'll get discussed on message boards or on the web or on social media. They will check out the site. They will see the winners. They will come on board, and it'll be the end of the trend. They found out late in the process, and they will end up getting hit on some trades. They will be negative about the site or negative about the process at that moment and blame everybody for their failures. In which case they will leave. They will go and try a number of other ideas. They'll even move lower in time frame. They'll get down to scalping or day trading more and more because they think that they need to make some money right now. And that thinking will bring them to more losses because there are more computers and algos and high frequency trading at those lower time frames. But eventually they will come back. And the way they will come back is because the market will start doing well again. Dan will have had some big winners. Note that these winners are probably up 20 or 30 or 40% at this point. And they will come back onto the site. And they will hear positive things from other members, but they will find that their buys work for a very short period of time, and then they won't work anymore. And they'll wonder and say, well, Dan's trades don't work. They're not working for me. But it's because of when they entered in the cycle of the market. It will be after when Dan has already made a bunch of money and other members have made a bunch of money. Now Dan will move to cash, and they will say, well, I can't really justify spending the money on a monthly basis to get no trades. I want to trade today. Feed me today. I need my cookie today. And in turn, what will happen is they will get bored and they will cancel. And next thing is they will go looking around. They will lose some more money. Unfortunately, at this point, their account is down 50, 70%, some absurd number. And they will then come back. And this time they come back, they will, many of them that have been through this period of time, will start to get the idea that they need to stick with it and follow a process. Generally, there's 2 to 3 cycles that are really powerful in a year. And when those happen, then you start buying a bunch of TBAs, your technical buy areas. And you start trading those while Dan is out of his heavy cash positions and he's moving into them. Now, on a day where we have a big up day, you'll always see people in chat who jump up and down and say, why is Dan so much cash? It's gorgeous today. Well, that's one day. You need a herd of stocks in a sector, in multiple groups, to set off that kind of strong momentum market that happens a few times a year. That's when TBAs are going to pay you enormously, when they're in herds. not when it's a lone ranger breakout. So the mistake that people make needs to be fixed because I'm waiting until all the TBAs set up so that I can switch gears and get more aggressive, get less protective of trying to buy little pullbacks and things. I, at that point, want to switch to look for the strongest name for the strongest move, like your Ren or your Twilio or your Acacia. That's what I'm looking for the big move in my account. But in the meantime, I'm watching as the charts develop. I'm reading and using my skills to make that special, individual, one at a time, solid trade while I'm waiting for them to set up and then turn into the momentum market. That's when my account really accelerates. That's when my equity curve steepens and gets stronger. Now, it's important that when the momentum market hits, you're in at the early stage. Remember, we like small stops. It's hard to buy small stops after the stock has moved up $12 that you're going to use a $1 stop. You need to catch them in the period when they're breaking out, not after they've broken out and they're far away from the tight area that they started from. That's why people lose, is chasing those breakouts and not realizing you're going to have to use a much bigger stop to catch that stock. So understand the cycle of humans, what they go through in trading. You don't deploy it every day. You deploy it like Dan does in the right market conditions. The rest of the time, you can either sit and read the market like I show you, or you can use the skills I teach you here, which I think is very good to make sniper-like trades. To sit there in the grass, hide in the grass, wait, see your target of what you want to attack, and do it one at a time, sharply and strongly toward a very clear setup. That's what a sniper does. We're not spray and pray. And when we're in a strong market, yes, spray and pray even works. But when we're not in a momentum strong market, you'll get chewed up. Now, a few more suggestions to improve your trading. And to improve your trading, I suggest that you focus on the right approach for the right market conditions. Pullbacks in a less momentum-like market, strength in a momentum market. And how to improve this is you read the book How to Make Money in Stocks by William O'Neill. I'm not even going to discuss his base patterns, which are very important. They're the patterns we talk about, but in bases, in long extended consolidations. And I'm not talking about what Dan discusses in Momentum Masters, even though it's critical to your success. So I suggest reading those books. Didn't put it here, but I suggest reading Darvis and Livermore. They're very good. They are two traders that were incredibly successful in their time. And the information they provide is very good about the thought process and the idea of how to trade, not buying dogs, focusing on the best moving stocks, things like that. I remind you, do not get lazy in reading the newsletter. I don't care that the market stinks. Still continue to read the market and stay aware. Those leaders and strong stocks will set up, while you're being negative, they will set up and make gorgeous, gorgeous moves. You cannot afford to be late to the next momentum move, which could triple your returns, and you can never leave the market. Okay? You cannot walk away. You can never leave the market and walk away. You have to always be watching. Unfortunately, even when I take a day, one day away, I miss some of the most gorgeous trades. It reminds me you can't step away. You have to be passionate and always wanting to be a part of the market. And the last thing on this page is stop aggressive buy entries until you see a large number of sectors and stocks trending strongly. I see people trying to buy the strongest breakout in the market while everything else is going down. Dan has a 50-50 rule, he always told me, which is if 50% of the stocks are going up and 50% of the stocks are going down, how far do you think you're going with your trade trying to buy strength, trying to buy breakouts? It's a gamble. It's not high probability. You're totally wondering if the market's going to give you what you want. You're asking for favors. Dan waits for buying stampedes, not one-day wonders, not the one big green bar that's up. That's not enough. You need buyers in mass. You need professionals acquiring and accumulating stock to make a momentum market. Now, that pretty much ends most of the housekeeping aspect. We're about to get into the charts. So while this took a while, and I know some of you may not love going over the rules and conditions on how to trade, these are, again, more important than even method, because without the right thinking process, you will apply the method incorrectly. So we're going to stop here, and you'll start the next video component to this after you're done. I suggest going back through this multiple times to make sure you've absorbed and understand how critical these items are to your success.